So today we're going to look at asset pricing models. The CAPM, the ICAPM, the multi-factor models. These are the ones that are used in practice for a lot of purposes. So first, just an introduction, a preview, where are we going? We're going to look at expected excess returns. The form of all these models is expected excess return is proportional to beta with factor risk premium. We use the letter alpha for deviations, for expected returns that are too high or too low. The betas, to remind you, they come from time series regressions. So if you're going to check this, you do two steps. First, run a return on the factor to obtain the betas. And second, the point of the model is expected returns should be higher where betas are higher. It's a cross-sectional model. So this is what the world should look like. Expected returns across assets should be higher where betas are higher. Everybody should line, in theory, on the line. Data is going to be some spread, so the data will typically look like the red dots. And we use the word alpha for the deviation and lambda for the slope, relating expected returns to factor risk premium. So this is for a general factor F. The question is, what are we allowed to use for factors? What can we put on the right-hand side here of an expected return beta model? What are the rules of the game? How do we avoid finding an ex-post mean variance efficient portfolio? You saw last time this is guaranteed success if we choose as the factor the ex-post mean variance efficient portfolio. And I made a plea for we need some rules of the game to keep ourselves from finding something like that, which won't work out a sample and doesn't explain anything. What does it mean deeply to say we have explained expected returns by such a factor model? Those are the kind of questions we're going to go after. So far, we've got one factor model in mind. It's worth keeping it in mind. The consumption-based model, where the factor is consumption growth. Our goal is to put in other factors, the factors that are used most commonly in practice. So the capital asset pricing model uses as a factor the excess return on the market portfolio. So its statement is expected excess returns are linear in betas on the market portfolio. Now, a little digression. You may not have seen it in that form before. If you've seen the CAPM before, you've seen something like expected return is proportional to beta with the market expected return on the right-hand side. And so we have to connect those two just to make it clear. Why does that work? Well, in the case of the CAPM, the market return is also a return and should also be priced by the model. The beta of the market on the market is 1. So the expected return on the market is beta times the factor risk premium. And that's what lets us, the theory predicts the factor risk premium is the same as the return on the market. So that's what the graph shows. The beta of the market is 1. The expected return of the market is there. So the slope is the same as the expected return on the market. So when the factor is a traded excess return, as the market portfolio is, then the mean of the factor should equal the factor risk premium. And a second, slightly deeper implication. Let's look at that time series regression again. Return equals alpha plus beta on the market plus epsilon. Again, that regression is just here to define the betas. Take the unconditional mean of that regression. You get average return on the left-hand side, alpha plus beta average return on the market. On the right-hand side, wait a minute. That's just our model. We've just run a regression and taken the mean of a regression. Aha, there's an alpha there. So one way of saying the same thing is that the prediction of our model is that the alpha should be 0, and the intercept in the time series regression is the error of the cross-sectional regression, and that error should be 0. Now this can get confusing. In the time series regression, that's an intercept, and that's a slope coefficient, and that's the right-hand variable. In the cross-sectional relationship, that is the right-hand variable, that's the slope coefficient, and that's the error. So it's much simpler this way, but a little bit more confusing. That's part of the reason why I tend to use lambdas to emphasize that distinction. And also, you can't play this trick for the consumption-based model. This is only true if the factor is a traded portfolio. That's why in doing the consumption-based model, I've been careful to use A's and not alphas. But to summarize, for the CAPM, you will see it in both forms. And for any model where the returns are traded factors, you'll see it in both forms. Okay, end digression. Our first example that we're going to look at today is the CAPM expressed that way, and now you know how to translate it to that way because its return is a traded factor. We will also look at the ICAPM and multi-factor models. Here, the factors go beyond the market return. They are innovations to state variables for investment opportunities or outside income. We'll have to learn what that means and how you're allowed to do that. A third example, one which I want to build to and try to understand what they were doing and why, is the Fromm-French model that we looked at from their famous Table 1. Here, Fromm-French ran returns on, this is the same thing as the market return, HML and SMB. And then the point of their model was that expected returns, there should be 0 alpha, and then the expected returns are explained by differing slopes, B, H, and M, on these 3 factors. So they went beyond the CAPM in this direction. Now mechanically, their factors were the returns on a value portfolio minus a growth portfolio, a small portfolio minus a big portfolio. Why? Why are they allowed to do this? What are the rules of the game that get them to this and let them say we have explained these expected returns with these factors? Well, that's the kind of thing that we want to think about today. And this frames it very well. This is what's used in practice, what kind of theory lies behind or is cited for the words in that famous paper. So we're going to derive models of this sort. I'm going to use 2 kinds of logic, equilibrium logic and arbitrage pricing theory logic. The equilibrium logic is quite straightforward. It's all going to be still the consumption-based model. But what we're going to do, we're going to decide we don't want to use consumption. Maybe it's badly measured. Maybe we don't want to use consumption. So we're going to use theories to substitute out for consumption in terms of decision determinants or other things that might be correlated with consumption. And we will use the representation results of the last few weeks. In the last few weeks, we've shown that discount factor, which is a linear function of the factor, means expected returns are linear in betas. So once I get here, I'm done, and you know how to fill in the steps to represent it in alternative ways. That'll save us a bunch of algebra. I got to warn you before we start, this won't be clean. You will hope for a beautiful, clean, well thought out theory, and you're not going to get it. Part of the reason is that we're doing history backwards. Historically, we started with the CAPM, then the ICAPM was developed, then the APT was developed, then multi-factor models were developed, and finally people figured out that the consumption-based model, though apparently the simplest one, is the most general one that encompasses all of these. And all of these got used into practice. Logically, we now go the other direction. We understand the consumption-based model is the simplest one, and all the others are special cases. But once you understand that, it's less clear why would one go do this. The defense I'll give you for now is this is what's used in practice, and you need to understand the models that are used in practice. Part of our goal here is to learn the language of finance, learn what people are using, learn how it is or was derived, and that's what we're going to do today. So I want to start with a really simple derivation of the capital asset pricing model. Not the most general, but it gives you a real sense of what we do when we derive asset pricing models. So we're going to do a 2-period quadratic derivation of the capital asset pricing model. Our objective is to get a discount factor that's a linear function of the market return. Because by our theorems, once we've got discount factor as a linear function of the market return, then we have an expected return beta model, and we don't have to go through that algebra. So how do we get there? Here's a set of assumptions that deliver the trick. First, utility, I'll assume a quadratic utility function. It's kind of an ugly utility function. I graphed it here. A quadratic function goes like that. You don't really want to use it past what's called the bliss point here. We think of this as an approximation to something more reasonable. So if that's the utility function, marginal utility growth is just C star minus CT plus 1 over C star minus C. That's my MT plus 1. Next, I want to assume this investor lives for 2 periods and then dies after time t plus 1, doesn't have a job, and doesn't have any outside income. When I do that, what happens? Well, then tomorrow's consumption is just the rate of return on invested wealth times the wealth left over after today's consumption. He starts with wealth, W, eats C, invests it, and then tomorrow he's got to eat CT plus 1, and then it's curtains for our investor. So what's the discount factor? Beta, C star minus there's tomorrow's consumption over today's marginal utility growth. And then let's rearrange it. The only thing with the t plus 1 here is RT plus 1. So I'll take this term here, and then the next term, all the stuff multiplying RT plus 1, I'll just condense that into an RT plus 1. And what do I got? Discount factor is a constant minus another constant times RT plus 1. These constants vary over time. They're time varying. So what we have is a conditional capital asset pricing model of the kind we talked about last time. Time varying constants, but then the uncertainty WRT plus 1 is all handled by the market wealth portfolio. Now, assumptions are here not because they're realistic, they're here to reverse engineer the result we want. And that's what these assumptions do for us. What do we need to get the CAPM to work? First of all, we need that the return on the wealth portfolio, and only the return on the wealth portfolio, drives tomorrow's consumption. How do we get that? Well, we made the guy die after tomorrow. So whatever he's got, he's going to spend in the time before he dies. And we also, the point of the CAPM is not that return on wealth drives consumption. Yeah, duh, return on wealth drives consumption. The point of the CAPM is that only the return on wealth drives the consumption. So for that, we got to rule out he doesn't have a job, he doesn't get any other source of income. So that's why we make those assumptions, to make the return on wealth drive consumption and not other stuff like labor income, news about the future, other things that might happen. The second thing we need M to be a linear function of the return on the market or wealth portfolio. How do we do that? We used quadratic utility. Quadratic utility is a nice device for getting us linear. Okay, lots of other assumptions get us to the same place. Possibly more realistic, possibly not, but you've seen what we're doing. We're using an equilibrium model. We're using utility function. We're using the resource constraint. We're making assumptions to derive what consumption is in terms of other things, and we're making assumptions to give us the linearity that we need. That's a little peek into the sausage factory of deriving factor pricing models. So there's lots of ways to derive the capital asset pricing model. Our job is just to get rid of consumption and put in the return on some portfolio in its place. Let me show you one that's one of many that's a little bit prettier than the quadratic two-period one we did last time. Let's suppose our investor lasts a long time and in fact lasts forever with power utility. That's a little more reasonable. We've already dealt with this situation. We found that the discount factor would be proportional to margin utility, which is just consumption minus gamma. Then we used Ito's lemma to express changes in the discount factor in terms of consumption growth. And we found our basic asset. This is the consumption-based model in continuous time. Again, we're going to start with the consumption-based model and then substitute out for consumption. So in continuous time, with this utility function, expected returns is gamma times the covariance of a return with consumption growth. And that came from the general formula, covariance of return with discount factor, and then the substitution that the discount factor was proportional to consumption growth. So that's where we started with. Our job is, can we get rid of consumption growth and put the wealth portfolio in there and say we've derived the CAPM? How could we do that? Well, suppose we could find an asset suggestively named PW, and suppose that asset's price was always proportional to consumption. So as consumption goes up and down, the price goes up and down, but the ratio of price to consumption was always the same thing. Well, if you could find an asset like that, then of course dP over P would be the same as dC over C. Its growth rate would mirror the consumption growth rate, 1 for 1. And the return on such an asset would be D over P plus whatever stream of dividends it gave off. In fact, this one is going to give off CT as a dividend, but that part isn't going to matter in the pricing. When we look at any asset, if we could find this asset here, we would substitute dC over C for dPW. The only place dC shows up here is in the Ito term, so any extra dt terms don't matter. In sum, if we could find an asset like that, then the expected return on any asset would be the risk-free rate plus the covariance of our asset's return with that asset's return, the special PW asset return. Or in discrete time, again, we're right away to a beta pricing model. So how do we find the magic asset? Well, an asset that works, an asset that has this property, is the consumption claim with some extra assumptions. So let's meet the consumption claim. It's also one of these objects you'll see over and over again in the theory of asset pricing. It's the price of an asset whose dividend stream is consumption itself. So what are you worth? Well, you are your future consumption stream, so the expected discounted value of your future consumption stream, that's in some sense the value of you. That's the consumption claim. Okay, now what does it take to make this consumption claim have a price always proportional to current consumption? Well, here's one set of assumptions. Suppose that consumption growth is independent over time. An IID world, every day you wake up and looks like every other day. For example, consumption growth could just follow geometric Brownian motion. What I'm doing here, geometric Brownian motion, means that there's no mu sub t. It means that mu there, for example, is always constant over time. Consumption growth is IID. That means the distribution of future consumption, given information today, always looks the same. Well, if you have an IID consumption growth, then let's look at the ratio of price to today's consumption. The ratio of price to today's consumption is just expected consumption growth. I've got the minus gamma, and then I've got a 1, because CT plus S over CT. But from any date t, this thing is always the same. The expected CT plus S over CT, I don't know what it is, but it's always the same. It's always some constant. So if we have IID consumption growth, even with an infinite horizon investor, then the price of the consumption claim is always proportional to consumption itself. I've got what I need. I've got something I can substitute out in the CAPM. Another set of assumptions that works, even if consumption is not IID, if there's all sorts of news, time varying means, variances, and so forth, suppose we have gamma equals 1, log utility. Well, let's look at our formula here with gamma equals 1. The ratio of price to consumption is expected. There's future consumption growth, and there is the dividend stream of the consumption claim. And you can see how nicely those two things exactly cancel. So if you have log utility, the price consumption ratio is always 1 over delta, even if there's all sorts of time varying means and variances to consumption growth. This is a deep result that comes throughout economics. Log utility, we say in economics, income and substitution effects offset. What we say in finance is cash flow effects and discount rate effects offset. If you get good news about future consumption, you say, well, wait, that should raise the price, right? Good news about future consumption, that's a good future cash flow, that raises the price. But good news about future consumption also raises the discount rate, raises the interest rate. And therefore, we have better future cash flows discounted at a higher rate. Log utility, those exactly offset. So now we've got it. These are two assumptions under which even with an infinite horizon investor, we can replace consumption growth with the return on the wealth portfolio, on the consumption claim portfolio. And we don't have to use consumption growth. We can call it the capital asset pricing model. So let's look harder at these assumptions. What is PW really? Well, that is the market portfolio return if, again, our investor has no job, no income, no real estate, nothing that isn't in that market portfolio return. Then we can argue to what extent stocks are really a good proxy for all that other stuff, or whether leaving out that other stuff matters in our empirical work. Why did we have to assume this no job business? Well, again, we want to link consumption growth and margin utility growth to the market return and to nothing else. If our consumer has a job, margin utility, when the market goes up but he gets fired, his consumption's going to go down. We have to get rid of that. Market return will still be a factor, but the point of the CAPM is that it is the only factor, so we have to rule out all those other factors. Why did we need gamma equals 1 or IID? Why were those important assumptions and very unrealistic assumptions? Because people aren't log utility and the world is not IID. Well, we needed to link consumption growth or margin utility to today's market return only. Even if he didn't have a job, if he got news of good future returns on the market, today's return doesn't do much, but he gets news of good future returns, he'll go out to dinner. So we have to get rid of that news of future returns, or we have to make him not care about news to future returns. We have to need those effects offset. So again, these assumptions are reverse engineered to deliver what we're trying to get, to link consumption growth to today's market return and not to news about future market returns, not to news about jobs, about real estate, and about other stuff. We needed linearity. Here we got linearity the elegant way out of continuous time. If you do this in discrete time, you can get to linearity too, but it's ugly. In discrete time, we get M is 1 over the rate of return on the market portfolio. But 1 over isn't a traded portfolio, so we need to talk about approximations and so on and so forth to get the desired linearity that gives us what we're looking for in the end, which is the capital asset pricing model. That's about as good as I can do, and you should be very unhappy. What are we doing with such an obviously crazy model built on such obviously unrealistic assumptions, like people have no job? Well, it works. Okay, but what are we doing saying this explains something? Well, that's a deeper philosophical question that we'll have to come back to.
So can you go into more detail by what exactly you mean by these models working?
Yeah, what I meant is it's a common defense. You know, somebody will present a model, you'll raise your hand and say, but those assumptions are crazy, and you'll say, yeah, but the model works. The capital asset pricing model actually works better than is commonly thought. It works for some sets of securities and not for others. So we saw on the first day that if you line up the size portfolios against their betas, they actually line up pretty well. The capital asset pricing model doesn't work at all on value portfolios, but it does work in some areas. And that's the way most of the models are. But I really meant the comment as for example, the Fama-French model, it may not be theoretically pure, but it works, or it's said to work. And so most of these models, in practice, people are not that concerned with the purity of the assumptions. They're concerned with whether it works or maybe doesn't work in practice. So a question for us to meditate on is, what are we doing with models with kind of crazy derivations, but that sort of work in practice? What does it mean to say that you explain something with a model of that sort? Whether or not the capital asset pricing model works or not is less relevant. This is a question for the larger set of models. Well, let's take the next step. We got to the capital asset pricing model with the assumption, the realistic assumption, gamma is not really one. The realistic assumption is that, let's suppose the world is IID. But the world isn't IID. We know that returns are forecastable all the time. Forecastable. In the first day, we looked at evidence that returns can be forecast with dividend price ratios. So what happens then? Well, the ICAPM is a step trying to keep the flavor of the CAPM, but to incorporate this observation as well. We'll do this in continuous time. So, for example, suppose that the returns can be forecast with X. That means that they might follow a process like this, where X is higher, that means the expected return is higher. X is now a state variable for investment opportunities. That's a code word you'll hear, and this is exactly what it means. When X is higher, expected returns are higher. How does that affect our asset pricing model? Well, intuitively, if you get news that you live in a world with better investment opportunities, that's good news for you. Even given your current wealth, better investment opportunities, that's good news. That means you'll be rich in the future. You might as well go out to dinner tonight and enjoy yourself. That means marginal utility will fall. So news ought to affect marginal utility. News ought to be an additional factor. Let's do some math and see how that works. So the way to approach this is to define it. Here's another concept you'll see. V is the value function. V is defined as how happy, the achieved level of happiness. So the investor is trying to maximize expected utility, and his constraints are he only has a certain amount of wealth to start with, and he lives in a world where today X, this state variable of investment opportunities, is given. He does the best he can, and then V is the value function, the realized level of happiness. Next, there is an envelope theorem that says the derivative of V with respect to wealth is the same as the derivative of utility with respect to consumption. That's a very intuitive theorem. It says the value of a dollar saved is the same as the value of a dollar consumed. If you're at an optimum and a dollar floats in, how much happier do you feel if you save that dollar for tomorrow or if you go out and eat that dollar right away? If you're doing a good job of optimizing, those two things should be exactly equal. If they weren't equal, you should have taken a dollar out of savings and eaten today, or vice versa already. Now that's very useful for us. Look right there. It's going to be the key that lets us substitute out, get rid of marginal utilities of consumption in terms of W and X, which is our goal. Our goal is don't use consumption, use determinants of consumption, use something that a theory tells us ought to be linked to consumption instead. So how are we going to do that? We're going to do that with our friend Ito's lemma as usual. So what does this say? It says that the marginal value of wealth equals the marginal utility of consumption. Take our usual, and that's the same as the discount factor. Take our usual Ito's lemma, and what do you get? You get the derivative of the value of wealth with respect to wealth times the change in wealth, the derivative with respect to the state variable X times the change in X, plus some more Ito terms. You should never leave out the Ito terms, but in this case we know they're all going to end up being dt terms, and we're only interested in the dz type terms. Because we're about to plug this into the risk premium, all these Ito terms will end up in RF, which we're not interested in. We're going to just plug those in there, so that's why I don't need to worry about them. So now we plug that discount factor into our basic asset pricing relationship. And what do we get? We get that expected excess returns equals the first term, this VWW term, times the covariance of returns with growth in wealth. And we get a second term, the VWX term, times the covariance of return with the change in the state variable. Or, now writing out the same thing in discrete time notation, the same VWW term times the covariance of return with the return on wealth, and the VWX term times the covariance of return with this X guy, or if in fact shocks to the X guy, which is what dx is. So what do we got? We got a two-factor model. Right away, that covariance is going to lead to a beta with respect to market. That covariance is a beta with respect to X. A two-factor model has emerged. The two factors are return on wealth, no surprise, but now shocks to news. And you know, with more variables, you're heading to something like FOM and French, which is one of the places we were heading. Now let's look a little bit more carefully at these coefficients. This guy here, VWW times WVW, you've seen that before. That's the same expression that as derivatives of the utility function that gave us gamma. This is risk aversion. In fact, this is the correct definition of risk aversion. Risk aversion really is the curvature of the value function, because we measure risk aversion by asking people how would they react to betting $1. Your reaction to bets on wealth. That's in fact the correct definition of risk aversion. If the value function has this power form, it's our friend gamma again, but that quantity is risk aversion. What's this quantity here? What drives the pricing effects of betas or covariances on X? Well, VWX over VW, that tells us if X changes, what's the effect on marginal utility? So if you get a big shock to this news, how much does that make you hungrier? Well, that's a natural aversion to the change in the state variable, just as this is the aversion to changes in wealth. Now, it's a property of the value function, not the utility function. There's nothing in preferences that tells you how you feel about news and future opportunities. It's a property of the value function, which is a result of the entire environment, the investment opportunities themselves, as well as utility. But you can think of it as sort of a utility function. How unhappy are you made by news that stock returns over the next 10 years are going to be good or bad? If you know you're not going to live for more than a year, it doesn't really care that much. If you know you're going to live longer, for example, that thing would be a bigger number. So assumptions, what have we done? We've taken the standard cap derivation. We've gotten rid of the ID thing. We've incorporated news. Our investor still doesn't have a job. Maybe we should do that next.
So can you explain in more detail the constraint that the agent is facing?
Yeah, I kind of waved my hands here a bit, didn't I? In part because for the current point, it doesn't really matter. So this ... here means there's a whole set of equations that I didn't write down. But without writing them down, let's talk about what we have to write down there. We have to tell the agent how wealth evolves. So if he puts wealth in today, then the return on the portfolio gives him how much wealth tomorrow. And if he eats today, that subtracts out from the wealth. So we're going to have a wealth evolution equation there with the rate of return on the portfolio and subtracted by consumption. X is going to be in here, so we're going to have this equation here is going to have to be there. But that equation also describing how the time varying rates of return on all the assets behave. And we're going to have to write under here that the consumer chooses consumption at each period, but also portfolio weights at each period, and that makes it a little more precise. But for the purposes of what you can kind of fill in, how you fill those details in doesn't matter. There is a value function out here. The value function will depend on those details and also depend on how much wealth you got and where you are in your XT today, no matter how we fill in those details right. So we started with the CAPM, where the investor had no job or outside income and lived in an IID world. The ICAPM generalized this by putting him in a non-IID world where investment opportunities change over time. Now let's give him a job. Let's give him a job, let's give him a business, let's give him some real estate, some income that isn't included in stock markets, but nonetheless he can use to eat. I'll start with the simplest version. Let's go back to our 2-period CAPM and see how this is affected if we give the investor a job. So all I've done here is write down the same situation, but in green. Let's add tomorrow, he's going to get a job, and Y is going to be the income he's going to get from his job. So he's going to eat whatever wealth he has plus the income from his job. How does this change things? Well, then our discount factor is C star minus consumption tomorrow, so we get the new term, income from the job. When we regroup things, keeping the T+1 thing separate, we're going to get a constant, we're going to get the return on wealth portfolio term, and now we're also going to get the income from his job. So the discount factor is A minus B times return on wealth portfolio, and then a constant times labor income. Labor income just shows up as another factor. So we're going to get a two-factor model now with wealth portfolio and shocks to labor income as the two factors. So you see, well, I guess in detail what I said before, the point of the CAPM assumption that he has no job is not to get the market portfolio in there, it's to make sure that only the market portfolio is in there. This investor is going to value assets also that affect his labor income, that are correlated with his labor income. Well, that's today's labor income. Now let's kind of add the two features together. If this investor has news about his future labor income, he's trundling along, minding his own business, and his boss says, oh, you're going to get a big bonus at the end of the year. Well, that's good news. That raises consumption, that lowers margin utility. That's news about future income. Surely that's going to affect asset pricing too, right? Well, how would we fit that in? We would write something like labor income. The change in labor income is, there's a drift term, and I wrote it, today's income or today's news variable, X, a news variable about future labor income, would enter. Wait a minute, I've got all the math I need for this. The math for that situation is exactly the same as this situation here. X now, if we interpret X as a state variable that tells us about future labor income, then of course good news about future income is going to raise the value, your value today, raise and lower margin utility today. So exactly the same math goes through. We can do everything we've done before, except now we're going to interpret VWX and this covariance here as covariance with shocks to news about future outside income, as well as shocks to news about investment opportunities. It's just those kinds of news shocks are another source of potential factors. So when we put together, when we add outside income and we add state variables for outside income, we just keep expanding the set of things that could be additional factors. The wealth portfolio, outside income shocks themselves, news variables that are news about future outside income shocks, variables that are news about future investment opportunities. We're starting to get a fairly large zoo of factors, but that's where we're going. Let me step back a minute from derivatives of value functions, talk a little bit more about the intuition of multi-factor models, and I want to try to get you to believe them. So let's turn this. Let's look at the portfolio logic behind how multi-factor models might work. Let's take outside income or the possibility of unemployment as an example. Consider two assets, assets A and B. And assets A and B have the same mean, the same standard deviation, the same beta on the market portfolio. So they must yield the same expected return, right? And to you, they're the same asset. You might as well just split your portfolio between assets A and B. They look exactly the same. Now, let's add that in a recession, you're likely to lose your job. And let's also add that in times like that, times when unemployment spikes, stock A goes up and stock B goes down. In thinking about the time series regression, we had the returns equals alphas plus beta on the market portfolio plus an error term. What I'm specifying here is that given the behavior of the market, they're the same in this regard. But in a recession, A will have a positive residual and B will have a negative residual. Their risks come at different times. Well, what would you do knowing this circumstance? You want to buy stock A, right? These stocks are no longer the same to you. The stock that goes up in the same times when you tend to be facing job loss, that's a good stock to own. Well, nothing better to cushion the bad feeling of unemployment by getting a big check in your mailbox. Conversely, stock B, get rid of stock B. Here is a stock that if you own it, when you lose your job, you also lose all your money in your stock portfolio. That's a terrible stock to own. So what's going to happen, however, if everybody does this? If there's a lot of investors in your boat, they'll all try to buy stock A. That drives up the price of stock A and drives down the expected return of stock A. Similarly, everybody trying to get rid of stock B, well, it's a hot potato. We can't get rid of it. All we do is we drive down the price and drive up the expected returns. So in equilibrium, remember we're thinking about a market in equilibrium. In equilibrium, what happens? In equilibrium, it's no longer true that the expected returns just depend on the market betas. This tendency to provide insurance against job loss or to exacerbate the pain of job loss shows up. Expected returns will depend on their betas with the market portfolio, but will also depend on their tendency to go up and down when there's a lot of unemployment. The thing that was alpha before, these would show up as alphas. And if you only use the CAPM, these would look like alphas. But what were alphas before now will show up as betas with respect to another factor. This is how multi-factor models develop. We find paradoxes with respect to the CAPM, and then we often discover that no, those paradoxes, those alphas, can be explained as betas with respect to some other factor. Looked at in terms of the time series regressions, what happened? Well, now if we run a regression, beta on the market and beta on the unemployment rate, for example, these two assets will have different beta on the unemployment rate. One goes up, one goes down. So what was just a residual, what was alpha plus residual, is now beta plus a new residual. Some of this residual is soaked up in their tendency to move with the unemployment rate. Intuitively, where do state variables come in? Well, this is about current unemployment, but news of future job loss is just as bad. If you're an investor, if you can identify stocks that reliably tend to go up in the states of nature when you're reliably to get news that your job is going to be bad in the future, then you want those stocks. If I could find stocks that would go up reliably on news that there's no more demand for tenured finance professors, I would want to buy stocks like that. The news of the future and current events are both things that we want to hedge against and will therefore try to drive up or drive down stock prices. Another point from this example, however, is it must be an aggregate hedging demand in order to affect prices. In fact, there's not that many tenured finance professors. So if I can find stock like that and buy stocks like that, and even if my 20 buddies do the same things, we're not going to affect prices that much. So the kinds of events, we're always back to aggregate events, the kinds of events where everybody's trying to buy or lots and lots of people are trying to buy, those are the kinds of events, the kinds of hedges, the kinds of state variables that will affect excess returns. And that's why they have to be aggregate hedge demands in order to qualify as factors and to move prices around. So the idea that people would demand stocks that help them hedge against bad news to their employment or their business opportunities, I think that one's intuitive. This intertemporal state variables for intertemporal opportunities is a little more nebulous. So I thought I'd give an example of that one too. Long-term bonds are, I think, one of the best examples to help make that come alive for you. It's a real puzzle. Why does anybody hold long-term bonds in their portfolios? Let's just look at, I made up some numbers, but these aren't too far off. Let's look at the expected returns and the standard deviation of returns at a one-year horizon. By a one-year T-bill, you might get on average about 1% with a standard deviation of 0. It's risk-free. If you look at stocks, you might get a 7% mean with about a 16% standard deviation. That's a Sharpe ratio of a half, pretty good. But long-term bonds are terrible. They have means that are just about like Treasury bill means, and they have variances that are about like stocks. If we plot them in mean variance space, Treasury bills here, it might be here, the NYSE might be there, portfolios that combine the two might be there, and long-term bonds are down there. Lots of standard deviation, no mean. Why does anybody hold them? How can that low mean persist in equilibrium? Well, one answer is, to a long-term investor, long-term bonds are wonderful hedges to their own investment opportunity set. What does that big flowery language mean? Let's look at the price of a long-term bond. So I have in mind a long-term bond here that might a zero coupon bond that will mature in year 10. And it's a US government bond, so there's no credit risk. It's a TIP, so there's no inflation risk. And let's look at its price over time. Price goes up and down over time. But you know that it's gonna pay off in year 10. So what happens if the price falls today? If interest rates rise today, the price of the bond falls today, boom. That's terrible news. You wake up the next morning and you've lost a lot of money in your bond portfolio. So that's the risk. That's the risk that we're measuring here. There's a lot of terrible news in long-term bond returns. But that news carries a silver lining. Bonds, of course, mechanically, when the price goes down, the yield goes up. When the price goes down, the expected return going forward goes up. So if you've invested in long-term bonds and you wake up one day and you've lost all your money, your job is to convince your spouse this was a great investment after all, because you lost a lot of money today, but the expected returns going forward are much bigger. So in fact, by year 10, this is still a riskless asset as it ever was before. So long-term bonds have two components to them. There's shocks to current wealth. They're bad from that perspective. But the shock to current wealth always happens with good news to future investment opportunities. Those two things balance each other. And that's why, for a long-term investor, it makes sense to hold long-term bonds.
So the point of this picture is that a long-term bond, the return is riskless over the long horizon, right? You don't really care about what the short term is doing if you're saving it for 10 years.
That's exactly right.
That's
A much better way to look at long-term bond investments is to take a 10-year horizon, to look at it as a 10-year horizon, and then it's just a riskless asset. But we don't. And an interesting feature, when we do this Merton-y stuff, we end up with conditional expected returns for one period equals conditional covariances with wealth and conditional covariances with state variables. What you've just said is something very, very deep. That in a world where there's time-varying information and long horizon investors, maybe instead of looking at these things in one period risk and return, it's much simpler and a much deeper and easier way to analyze things to look over, in fact, the investment horizon of the actual investor. Maybe we shouldn't be looking. What you should do is just tear up the envelope because it's a risk-free asset, and don't even get in that argument with your wife. Yes, I think that's a good and deep point. I'm actually, you just advertised my latest research paper where I'm trying to do this, and we're working on techniques to do that. But I think it's a deep observation that in a non-IID world, looking at things in instantaneous return space, this is just a terrible way to think about a long-term bond. You're exactly right. So now I'm going to let multi-factor models go really out of control. Let me start with a different kind of intuition. I emphasized before the portfolio intuition. Investors are trying to buy securities that hedge other shocks to news or labor income that drives expected returns off of what the beta times the market predicts. The other way of looking at it is just directly as proxies for consumption. We have an underlying theory that M should be the discount factor is proportional to marginal utility. So let's just think about stuff that might affect marginal utility or hunger, the inverse of consumption, or might affect consumption itself. Any of those are inspiration for multi-factor models. Obviously, the return on the stock market is going to affect marginal utility. It's going to affect consumption. It's going to affect marginal utility. News about future returns is going to affect it. Current and news about future income in your business, in your real estate, all of these things are legitimate. Of course, if you talk to a macroeconomist, they write whole models that relate consumption growth to GDP, investment, unemployment, interest rates, productivity shocks, you name it. So under the same philosophy, we could use those relationships to proxy consumption for its macroeconomic determinants. And in fact, lots of people have written down factor models where they look at expected returns relative and then betas on GDP growth, investment growth, and so on and so forth. Furthermore, just to give you more tools to play with, we have the mimicking portfolio theorem that justifies lots and lots of different kinds of portfolios as factors for factor models. Again, the theorem, suppose you start with a discount factor is linear in GDP growth, but you don't want to use GDP growth data. Well, let's invoke the mimicking portfolio theorem. Our objective was to find reasons, excuses for using portfolios on the right-hand side. We can just project M onto X. And as you remember, projecting M onto X produces an X star, which prices exactly the same way as the original M. So if you believe that factor model, then you believe this set of portfolios. In practice, project just means run a regression. So if that's income growth, you could regress income growth on asset returns, and the right-hand side of that regression is a portfolio. Heck, you could just run consumption growth on asset returns and think about the mimicking portfolio for asset returns. People tend not to run these regressions, but they tend to invoke that theorem and say, well, maybe my asset factor is in fact a mimicking portfolio for some macroeconomic variable. We're left at a fairly uncomfortable stage. We now have a fair zoo of asset pricing models, a fair zoo of factors we can use. Fama called it a fishing expedition, or a license, the ICAPM, a license to go fishing for factors. And I think we need to think a little harder and bring some rules to the game back. So let's next think a little bit about what all these assumptions mean and how to use them. So we've spent another day looking at assumptions and theorems and derivations. What does it take to get from a discount factor model, from the consumption-based model, to the CAPM, the ICAPM, multi-factor models, and so on and so forth? As before, knowing these assumptions and derivations, I think, helps you to be much clearer about what you're doing, why you're doing it, what kind of model is important for what kind of application. All of these models, now that you've seen how they're derived, they replace consumption growth with the determinants of consumption growth in one way or another. And that's an important realization. Quite often you'll find people say, oh, that consumption model, it's terrible, everybody knows people are irrational, we'll just use the CAPM. Well, I'm sorry, the consumption model is the CAPM is the consumption model. The capital asset pricing model is a special case of the consumption model, where we assumed, in addition to what you may feel is too much rationality, we also assumed that people didn't have a job, which is even less realistic. They are all special cases. They are not alternatives to the basic idea of the consumption-based model. And in fact, the consumption-based model is the most general. It is the one that subsumes all the other ones. Every single one of these other models also has in it as a prediction that consumption growth should be the single pricing factor. We just, for some reason, we don't want to use consumption growth. We don't want to think about its measurement problems and so forth. But it's in there in every single one of these derivations. That's a useful thing to keep in mind as something you've learned by watching the derivations. You've seen that the assumptions are in fact very special and not at all realistic. And that's the way of all economics. Economics, we make quantitative parables. We don't make deeply realistic models, and we make the models as complicated as necessary to work in practice. That's the way it is. I wish that the assumptions were more realistic, but they're not. When we look at these models in practice as well, you'll be profoundly unsettled that the derivations and the assumptions, they're used for inspiration, but nobody takes them seriously in a scientific testing or checking matter. I mean, they may write in their introductions, we're going to test the capital asset pricing model, but then they throw out 3/4 of the implications that are testable in the data we have. An example, the capital asset pricing model included in its predictions is that the factor risk premium is risk aversion coefficient times the volatility of consumption growth. We just agreed not to look at consumption data. But this consumption data scream that this is a horrible prediction, because consumption growth volatility is only about 1 or 2%, so that needs a risk aversion of 50 or so to make it work. Another assumption in the CAPM derivation is that consumption growth equals the rate of return on the wealth portfolio. They move 1 for 1. That means consumption growth has a 16% standard deviation. That's a prediction of the model. Well, we're not that interested in that prediction of the model. That's okay. That's the way things work. You should just understand that the way finance works is not in this kind of pure scientific testing of every aspect of a theory, for better or for worse. That's how these models are used. Similarly, the ICAPM, we said that the X, the things that we're going to use as factors, should be things that forecast future investment opportunities, and that the risk premium isn't a free parameter. As the risk premium in the CAPM isn't a free parameter, the risk premium isn't a free parameter there. The risk premium should come from understood derivatives of the value function. Well, when using the ICAPM, it's very seldom that people even bother checking that their factors do in fact forecast investment opportunities, and almost unheard of for people to actually solve and check whether the derivatives of the value function generate the risk premiums or just take the risk premiums as free parameters. In the use of macroeconomic models and mimicking portfolios, with very, very few exceptions, at best it's, well, I've got some factors. Gee, these factors might be mimicking portfolios for some macro models. Let's go on. But it's very seldom that anyone takes the actual macroeconomics, works a macro model to figure out what those things are, actually finds the mimicking portfolios, and then tests those. I can't think of an example where that's true. I don't mean to be critical. This is how finance works. And our job is to study how finance works. Having studied these implications, you might expect a more scientific approach. That's just not the world that we're faced with and how things are done. But you should still be very unsettled by that, as I'm unsettled by that. The point of why we got here was we found a perfect portfolio, the ex post mean variance efficient portfolio. And I gave my last lecture and sermon about how important it was to discover some rules of the game that kept you from fishing around and finding ex post mean variance efficient portfolios. Well, if the rules of the game aren't to write down models and test them, what are the rules of the game? The rules of the game are a little bit more of an art. And we'll have to read some papers and think about how the rules of the game are being used, and you'll have to think about what the right rules of the game are. One of our next tasks will be to look back at the Fama and French paper and think hard about what rules of the game are they employing to keep themselves from finding an ex post mean variance efficient portfolio, and to convince you that they've done something, that they've run through adequate hoops, that in fact their model is an explanation, at least for the phenomenon that they want to do. But also, how many assumptions do you really use? Part of the reason for what you may regard as this unscientific loosey-goosiness is that in most applications, we don't use all the deep assumptions of the model. We don't really need them. Let me give you an example to make that a little more concrete. A most common thing that you do with an asset pricing model is you evaluate an anomaly. So suppose you have some strategy that seems to offer an expected return, maybe an anomaly, somebody told you some new great way to pick stocks, or maybe you're evaluating a fund. Maybe someone is trying to sell you, come invest with me and look at the great average returns that you get. What do you do with that? Well, you check whether that expected return is in fact justified by, let's just try the CAPM. And suppose you find it, the expected return, you find, hey, wait a minute, this anomaly, this fund, it's giving, the expected returns it's giving are exactly what the CAPM says it ought to be giving. Or equivalently, you run a regression of that return on the market, you find that there's the beta, no intercept. The CAPM explains this anomaly. That's a standard thing to do and a very useful thing to do, especially if you want to save yourself a whole bunch of fees from a hedge fund. But so what have we accomplished there, and how many of the assumptions did we really use? What can we say from that? Well, we can say, hey, wait a minute, I can get this anomaly return just by investing in the index. I can get that hedge fund's return just by investing in the index. This anomaly is not a new anomaly. If maybe the market's an anomaly, but it's a different version of an old anomaly. This hedge fund isn't doing anything new, it's just investing in the index. You've learned something else. You can learn, if I want to invest in this anyway, I can hedge that risk by shorting the index. Beta gives you a good hedge ratio. You've at least learned that this new anomaly is as rational or as irrational as the market. What have you not done? Well, you don't know whether the market premium's rational or not. There's a sense in which you haven't found a deep explanation of everything there is to know about the rationality of asset pricing. But you've certainly learned a whole bunch of things. Why? Because you didn't really use any of the assumptions behind the CAPM in using the CAPM in that fashion. And that's quite common in practice, which is why very often in practice, though people will write, I'm testing an asset pricing model, what they're really doing is using an asset pricing model to one of these ends that doesn't require so many assumptions. Furthermore, for what we've used, even if I know the capital asset pricing model is wrong, I know the CAPM is wrong, it doesn't price value portfolios, yet all of this exercise and all of these implications are perfectly valid, even though I know the assumptions of the capital asset pricing model are wrong, and even though I know the capital asset pricing model will not price value portfolios. Well, if it prices this thing, I've learned something very important about this opportunity. So that's a sense in which we use models, that it's a justification for using models, even though we're doing a terrible job of testing. You still can't use that observation to win a fight with a behavioralist. Well, you're asking different questions. So next I want to do the arbitrage pricing theory. This comes next because it's a fundamentally different logic, a fundamentally different approach to getting to the same end, which is a factor pricing model. So the goal, the arbitrage pricing theory has the same goal. Let's run a regression of a return on two factors in this case. And to make life simple, this will be an excess return, and the factors will also be excess returns on large portfolios. So the Fallman-French model would be an instance of this kind of regression where the market excess return, the value minus growth return, and the small minus big return would be the factors on the right-hand side. If we take the average value of such a regression, we get expected return is beta times expected factor 1, beta 2 times expected factor 2. We would normally get an alpha there, but our goal is to find some logic that the alpha should be 0. And if the alpha is 0, then the expected return is higher where the betas are higher with the expected values of the factors as slope coefficients. So again, that's just a factor model. Our goal is derive a factor model. Our goal is find some logic that alpha should be 0, but we're going to try it from a different way. We're not going to go from the consumption-based model. The idea of the APT is that if these residuals are small, then the alphas should be small. We're not going to prove alpha 0, but we're going to find some logic under which the alphas will be small without using utility functions, consumption growth, or anything else. Here we go. Start with this regression. So run your regression of the return on the factors, just like Fama-French's Table 1 regression. And then let's form a portfolio that is our left-hand return minus the beta times the factors. Stop and take a deep breath. This is something apparently simple, but very deep and very beautiful. What you've done here is used the regression coefficients on the factors as weights in a portfolio. Well, the factors are traded, so you're perfectly well allowed to do that. The same symbols now mean something completely different. Here they meant regression coefficients. Here you're going to form a portfolio long your test asset and short the factor portfolios using the regression coefficients as weights. That is one of the most useful things you can learn anywhere in finance. What we've created is a hedge portfolio. This portfolio has a minimum variance property, right? Because the errors have a minimum variance property. It's the optimal hedge portfolio. If you want to hold that thing and short out some portfolios that minimize variance, that optimally hedge the risks of that portfolio, a regression tells you exactly how to do that. Furthermore, it's a way of saying, suppose I want to invest in this thing and I believe it has some alpha, how can I hold just the alpha? If I hold the asset itself, I hold the alpha, but I also hold these factor risks. Well, use that portfolio construction to short out the factor risks and get yourself just the alpha. It's also called portable alpha in the industry. It's a way of taking the alpha profits of a strategy and getting them in purest possible form without also having the factor risks, which you can get for free. So having done that, having formed the optimal hedge portfolio, having formed the portable alpha portfolio, what do we have? The rate of return on your portfolio, the mean return on the portfolio is alpha. The standard deviation of the portfolio return is the standard deviation of the epsilon. So the Sharpe ratio of the portfolio is alpha over sigma of epsilon. A natural thing to do if you're thinking of exploiting this opportunity and shorting out the factor risks. Well, now let's make an assumption. How big of a Sharpe ratio can really last in markets? Yes, this is a little bit of a utility assumption. Well, the Sharpe ratio on the market's about a half, a Sharpe ratio of 1 or 2. Will that really survive, or will traders come in, bid up the prices, and get rid of expected returns? So the assumption that we'll make in the APT is that there's an upper bound for Sharpe ratios. Sharpe ratios beyond some certain upper bound just don't survive, and those expected returns will be driven down again. Well, if that's true, if the Sharpe ratios are bounded by something, then small errors must mean small alphas. This is usually stated in more formal ways. It's stated as a limit. If the Sharpe ratio is less than some upper bound, then as the errors go to 0, the alphas must go to 0. Or if you'd like to be even more formal, but actually meaningfully formal, if you can, for any error less than a certain delta, that tells you an upper bound on what the alphas can be. So the prediction of the APT is that alphas should be small where the squareds are large. If you can find factors that explain a lot of the return on your test assets, then in those cases the errors are small, the R squareds are large, and the alphas should be small numbers. A different way of getting to a factor pricing model. So let's talk about the difference between the APT and equilibrium models, such as the capital asset pricing model. They come from a very different philosophy. The capital asset pricing model and equilibrium models are, in a sense, they try to be very, very powerful. They're what I call absolute pricing models. If you have the consumption-based model, you should, in principle, be able to price absolutely any asset whatsoever. Stocks, bonds, real estate, the price of water, you name it. Marginal utility consumption growth, price it. It's based on deep fundamentals. The arbitrage pricing theory does something much less ambitious. It's relative pricing. In the arbitrage pricing theory, we try to find the expected returns of our portfolio in terms of the given expected returns of other portfolios. So Fama and French, in some sense, they're using this logic. They say, well, we find the expected returns of the 25 portfolios given the expected return of the market and the HML portfolio. Yeah, but why are the market and the HML portfolio, why do they generate their premiums? That model doesn't tell you anything about that. And in that sense, they're using that model as a relative pricing model, the way the APT says to. Another way to think about the two things, and there's The right kind of model is surely halfway in between. You want to start a restaurant that sells hamburgers. What should you sell your hamburgers for? Well, there's two approaches to this question. One approach is the Martha Stewart approach. Okay, what does it cost to raise a cow? And we'll build it up from deep fundamentals. The other approach is, well, I want to sell a hamburger over here, Burger King's over there. What are they selling them for? And how much more or less can I charge? That's relative pricing. They're both useful for different kinds of questions. One way of thinking about the difference between the model, does the R squared matter? So in our underlying time series regression, this regression here of returns on factors, that regression has an R squared with it. Is the R squared of that regression important to the theoretical derivation of the model? The answer is, for the capital asset pricing model and equilibrium models, absolutely not. The fit of the time series regression here is completely unimportant. What matters, this regression is only important for measuring the betas. The R squared is a little bit important for statistical reasons. The betas are better measured in samples with R squared, but it doesn't matter at all to the theory. In fact, it is the greatest pride of the capital asset pricing model to deal with R squared equals 0 securities. Here's an example. Suppose you had a security X here that was paying the same return as the risk-free rate, but had a huge standard deviation. That's a security that has an R squared of 0. That's sort of like my long-term bonds. The capital asset pricing model would treat it as a great success to say, well, the expected return of that security is 0 because the beta is 0. So the R squared being 0 is not only irrelevant to the derivation of the CAPM, but it would be a point of pride for the CAPM in being able to explain why a security like that can sit there and people hold it for a low expected return despite its awful standard deviation. For the APT, of course, R squared is essential. The point of the APT is you only expect small alphas where there are small epsilons, where the factors do a good job of explaining the variance of security returns. Another way of putting the same thing, and here I'm part of my linguistic approach, I want you to learn the languages. Does factor structure matter for factor pricing? Those are two very different words. Let's distinguish what they mean. Let's look at our time series regression of returns on a factor. A time series regression of returns on a factor implies a factor structure. When I think about the covariance of one return with another return, a component of that covariance is how much do their betas load up on the common factor. When I derive the covariance matrix of returns, well, the first component of that covariance matrix is the vector of betas, beta beta prime, times the times the variance of the factor. That's factor structure in the covariance matrix. Does that factor structure matter? To the APT, yes. The key assumption of the APT is that the common factors explain a lot of the variance of the returns you're looking at. To the CAPM, it doesn't matter at all. It's kind of a convenience, but we with an absolute pricing model, factor structure among the returns doesn't really matter much at all for the pricing. What's the relationship? The CAPM, like the Fama-French model, is often used as an arbitrage pricing theory. And that's in some sense why, for many uses, people don't get all upset about the assumptions. That's exactly really what I was doing in my previous example of using the capital asset pricing model in order to evaluate some anomaly. Well, I was using it as relative pricing. I was saying, well, the capital asset pricing model says expected return should equal betas times the market. I found that for this case. So given that the market is reasonably priced, this thing seems reasonably priced. I'm using the capital asset pricing model in a relative pricing mode. And that's, in fact, the way most practical finance is done. Most practical finance wants to know, let's price something in terms of other things we know, and please don't bother me with another sermon about whether the market's rational or not. I just want to understand this strategy. Another aspect of the APT, we do everything in moment space and state space. I thought I would take a moment to describe what the APT means in state space and how we think of the question in that geometry. So here's a picture of the APT's question. We have a payoff space. It is the payoff space generated by the factors. And we know the prices on this payoff space. The rules of the game are we're not arguing about whether the factors are correctly priced. We want to know, is the new payoff X priced correctly given the prices of the factors? That's the APT philosophy. Well, what does the APT say about this? Pure arbitrage says, I'm sorry, I can't tell you anything. This thing isn't in the space of included payoffs. Price of that could be anything relative to the prices of those guys. Well, the APT says, look, let's make a projection. Let's run x on the factors. That is in state space what this regression does in moment space. We're projecting x on the factors. We're finding the smallest possible residual. We're finding the hedge payoff that is closest to the original payoff. And epsilon, there's our residual there. So the APT philosophy says, look, guys, x is pretty close here. Epsilon's pretty small. What price can we assign to this? How can we extend the prices we know to the prices of something we don't know? If epsilon's small, why don't we just use the price of x hat as the price of x? And that's going to be a pretty good approximation. Let's just assume the price of epsilon. If epsilon is small, the price of epsilon must be small. So that's the philosophy of the APT. It's a way of extending the prices on something we know to the prices on something we don't know. Now, of course, the price of epsilon, we can't prove that the price of epsilon is small. What does it take for the price of epsilon to be big? Well, x star isn't the only discount factor. This is the same as using x star as the discount factor to price the x that's off the payoff space. But of course, any m here can be, that's a valid extension of the discount factor we have. This, if we use x star to pay off, that generates a zero price for x. What would it take to generate a big price for epsilon? Well, we need to use an m that's away, and the price of epsilon is the inner product of m with epsilon. So to get a big inner product here, we really got to move m a long way. And as we move m a long way in order to generate a big inner product, the size of m gets big. And recall, the maximum Sharpe ratio is related to the size of m, the second moment of m. So again, you can see in state space, assigning big prices to small deviations requires that you assume large Sharpe ratios can exist. I emphasize Sharpe ratios. Historically, it's called the arbitrage pricing theory. Where's the arbitrage? Well, there was a long effort to try to prove that those prices would be zero by pure arbitrage without having to make Sharpe ratio assumptions. I don't want to cover it. I don't think it's been a great success. It is a branch that's only used in theory, really, and not particularly guides empirical work or practical application. Last comment, of course, the APT being a relative pricing model, you can only, the APT is sort of like the famous story of the drunk who looks for his car keys near the lamp, even though he dropped them over there because that's where it's light. The APT can only hope to generate prices for things near the original set of payoffs. It only hopes for things that are large portfolios and therefore well spanned by existing sets of large portfolios, things that lead small epsilon. If you don't have those, then you really need to start thinking about, if you have large epsilons, then you really need to start thinking about absolute pricing, what the risk premiums of those large epsilons could be.
So couldn't you just include his job or his outside income in the wealth portfolio and then the model still works fine?
Yes, you could. And one way of thinking about this is the portfolio of human capital, real estate, private businesses, everything else in the economy. But then it's a measurement question. What we actually end up using is the return on the stock market index. So we actually, either you have to think of it as the wealth portfolio, and then that's the role critique. Well, but you left out all that other stuff. You're not really measuring the right thing. Or we just say the assumption is he doesn't have a job, and then we can identify that thing with the proxy that we're actually going to use in real life. So those are the two ways of handling the job or outside income question.